Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to Invested Dads Podcast, the podcast where we take you on a journey to better your financial future. I am Austin Wilson, co-portfolio manager at Hicks & Zerker Capital Management.
And I'm Josh Robb, director of wealth management at Hicks & Zerker Capital Management. Austin, how can people help us with our podcast?
We would love it if you'd subscribe, if you're not subscribed already. So hit that plus, follow, whatever the icon is on your player, hit it, and that really helps us get you what you need when new episodes drop. And it'd be great if you could leave us a review on Apple Podcasts or Spotify or wherever you're listening. And always remember, you can reach out on our website or email us at hello@theinvesteddads.com. We would love to hear from you, whether you have topic ideas or you just want to say, hey. So, Josh.
Yes.
Today, we're going to be talking about investing in real estate, which is super popular, and apparently you can't lose money. It's easy money, free money. You can become a millionaire overnight.
Yep. Pretty much what we're going to do, just say, hey, tune in to TikTok and you'll be an expert in no time. But actually, don't do that. Because
don't take your financial advice from TikTok.
No.
Ever.
Don't take much advice from TikTok in general.
Yeah.
I do, in there I have learned some Blackstone grill stuff.
Ooh, yeah.
So there are some things you can learn there. Yeah. Some
it's
recipes, things like that. But yes.
Dance moves
are, I got my own. I don't need theirs. But
I don't use TikTok anymore. I had it for a season.
Mm-hmm.
I don't really have anything against it. I feel like Facebook/Instagram/YouTube Shorts, like the Reels versus YouTube Shorts, is just as good as TikTok. So
yeah, they're all. Yeah, I don't even know what I would watch, whether it was Instagram or what, but it would be like a TikTok shared to that. So I didn't even watch like the real one, but it was just like a comment on the one.
Exactly.
I don't know. Either way, I think in general, though, there's a lot of people giving advice on real estate, especially recently. I feel like it's been a popular trend. You see a lot on like those home improvement channels. We'll talk about that in a minute. But yeah, there's been a lot of interest in real estate, partly because it's a different way of investing money. It reacts differently than the stock market and bond markets do.
True.
So it is and we both believe it's a diversifier in a well-diversified portfolio. Having some exposure to real estate is actually an important part of a diversified portfolio.
Some people go all in. It's all they do.
Yes.
And in a lot of instances that may work. In a lot of instances, that may also not work because you're not well diversified either, and we would caution against that. Obviously, that's not advice, but it depends on your situation. But that's it comes back to a point of balance, a point of a little bit of everything and not too much of one thing. Don't put all your eggs in one basket. All those old sayings really ring true when it comes to your investments. But yeah, real estate can certainly be one component of that. And so today, Josh, we have four ways that a person can make money during real estate.
Yep. The first one is one that probably may not even come to people's minds when they think about investing in real estate, but it's actually your home.
Right.
Your home is a real estate asset.
It's real.
It's a real estate. It's a property. But most people buy their home to live in, and they purchase it based on their needs, bedrooms and location and all that fun stuff. But it's probably one of the longest holding real estate assets you're going to have in your life. And maybe you sell and buy a new one. But in general, your home, when it comes to real estate, is going to be one of your longest held ones. Yeah. And as a result of that, you're going to see over the long run appreciation, and you'll have equity in the home. And when we talk about equity, it's the difference between what you paid or owe and what it's worth. So if I owe $100,000 and it's a $300,000 home, my equity is the difference, $200,000.
And when you pay off that home, you have 100% equity.
Yes.
You own the whole thing. Whatever it's worth is your ownership.
Yep. And unlike stocks or other investments, you can't just sell a portion of your home if you need a little bit of that equity. There are ways to access it, so you can get equity lines of credit where, in a sense, take a loan against that appreciated value of your property. So you can access it, but in general, though, when you think about investing in real estate, most people exclude that big asset from there. But I always say, that is probably most people's first experience in buying real estate.
Yeah.
Right? When you sit down and you buy your first home and you sign all that paperwork, it's a learning experience. You learn a lot. And maybe if you buy a home or two along the way, you sell and buy a new home, you get better at it, because that first time you just don't know, right? Oh man, I should have asked them to leave X, or I should have negotiated this, or you know what? I should have got this inspection done. You learn a lot. And so, your home can help you along the way. Even if you don't see it as a real estate investment, it can help you be a better investor in real estate. So that's the first one. And for a lot of people, that may be their only experience in real estate directly. So, but it's definitely one that you want to make sure you do a good job on, because you're going to be the one living in there.
And it's usually, if not your only, it's often your first. So a lot of people start with owning their home, and then they decide to look into other ways to access real estate. Because maybe, they've seen how the real estate market works. They understand a little bit. They've seen, hey, maybe my home price went up a little bit. I should do this with other things or whatever. So Josh, what's another way to invest in real estate? So
if you're buying property, another thing is there's two ways of buying property. We're going to talk about one. You got a dad joke, and we'll come back and talk about another way. So the first one is flipping homes, flipping real estate,
putting it on its roof,
like upside down and seeing if the other side grows better. No, flipping is just the idea of purchasing property with the intent to sell it in a short period of time. And they call it flipping because you do something to turn it around and then put it back on the market. And so the whole point of this is you buy it at a price with the intent to sell it at a higher price. Pretty straightforward. When I say it that way, it sounds real easy. Buy it and then sell for more. But here's some things to think about. The first one is market trends. And so when you're buying in an area, understand, what are the prices doing? Are there a lot of homes for sale? The more homes for sale, the harder it is to sell yours, right? Because there's a lot of options out there. What has happened? What are the last handful of homes sold for? More or less of what they asked for? How long did they take to sell? Understand the trends. And then along with those trends of the market, understand what's going on with interest rates. Because although your intent is to sell it, there will be a time period you own it, and you're going to have to pay on it. So understand what that cost will be. Location and the condition of the property. So not just is this home good, because there may be things that you need to improve, and that may be why it's on sale. There are sheriff sales, there are, people who go in foreclosure, and you can get a property very cheap. Sometimes they're not in the best shape. That's not a bad thing if you understand going into it what the shape is and what you're getting. But location is important too, because if you're looking to resell this, will the next person want to buy it? Am I in a good school district? Am I close to transportation? Do I have amenities that somebody would want to own this property with? And so making sure you understand what's going on around is important.
It's always, people always say, buy the worst home in the best neighborhood that you can afford. Right? So like, if you think about, if you're trying to make money on something, whether that be your actual primary home or an investment property, you should want to buy a home with more expensive homes around it, because then they're bringing up your property value and you have a lower cost. So that's kind of the golden rule when you're buying a home.
Budget. So again, you're going into this knowing you're spending money, one, for the purchase of the home, probably for repairs, updates, those type of things, in the intention then to sell at a higher price. You got to make some reason that somebody will want to pay more than what you paid for it. And so understand how much that'll cost, how long you think it's going to last, because that's the next one. Number 5 is time frame. So those two go together, is cost and time. The longer the time, the more the costs are going to be.
Right.
So you got to balance that out. Well, what repairs am I doing? Are these big structural repairs? Is it going to take a while?
Am I going to do it myself?
Am I doing it yourself?
Hire someone to do it? Sweat equity is cheaper in the dollar
That's
term.
where the budget comes in.
Exactly.
You could pay somebody to do everything, but if I do this, this, and this, that cuts the cost down. And so budgeting is very important. And then on the back end, selling costs you may have to have a realtor. There's going to closing costs, things like that. Make sure all that's accounted for, so you know how much you need to sell the home for. Then you go back to your market trend and say, if all set in, this is what it's going to cost me. Can I make a profit on that? So you got to really factor that in.
And your time frame, and you need to factor in different tax situations. If you hold it less than a year, then obviously you're going to be paying, it's normal income tax, right?
Well, for property, it's
one property.
Yeah, I think it's a little different. But in general, most home flippers, it's all short term because they're not trying to hold it much longer than they have to. And then the last one is legal and regulatory requirements. Hey, let's say you are doing some repairs. what's the zoning permits? What's the rules of that area? Yeah. You may want to put an addition on the home, come to find out that neighborhood has rules. So make sure you understand what you can and can't do prior to building it. Yep. And then also when it comes to the actual laws of that area is, what is my final intent of this property? Am I going from a single family home to a multifamily home? Maybe they don't allow that. So just understand the rules for that.
All right. So we're 2 down, 2 to go. Let's take a break.
Yes.
Dad joke, more of a thought, more of a story job.
All right. I'm ready.
So I was in my room. I saw a group of 10 ants running frantically. They were going crazy. So I felt bad. I made a small house out of a cardboard box. This technically makes me their landlord, and they are my 10 ants.
10 ants. That goes well with what we're talking about.
With what we're talking about next,
in
which
fact,
is rental property.
Rental. So
because this is how everyone on TikTok wants you to make money.
Yes.
It's like Airbnb arbitrage.
Yes.
And being the landlord.
Yes. And that is so instead of buying a home with the intent to sell it in a short period of time, this one is you're buying a home with the intent to have somebody pay you ongoing rent. Whether that's long-term rentals where you have somebody living there or like a vacation home, right. Weekend rentals, short-term rentals. Yeah. And so 2 different approaches. You're not necessarily looking to get the most value out of the home from a sale price, but to get an ongoing income stream from this property. So the first thing to think about here is the same as before, location, right? That's very important.
Location.
And not only is location important, but the type of rental you're looking to do, location matters even more. So a property type, so some examples of that would be a single family home, which would be for one family, multifamily home, townhouse, apartment, condominiums, commercial property. So you could own a business building, right? And so what type of property you're going to manage, location is very important, right? I don't want to be in the middle of downtown and put a single family home there.
No.
Not ideal.
Not ideal.
But maybe I would want an apartment complex right by downtown where everybody wants to get close to all the amenities. Mm-hmm. So you got to think through what it is and think through the location. Let's say a vacation rental out in the middle of nowhere, probably not a good idea.
Probably not great.
By the beach? Perfect. I want a rental property there. So think about location and then the type of property you're trying to do. Do a whole financial analysis. This is back to kind of what I talked about. It's like the budget thing. Maybe you need to do repairs to get it up ready for the rental. But in general, the bigger question is, what is my ongoing costs? How much can I rent it for? What's the rental cost for the area? And what's my return on my investment? Because the idea is, let's say I can charge $1,000 a week to rent this thing out, whatever it is. But what if my all-in costs end up being $1,500 a week? I'm not going to make any money on this thing. Nope. So you got to run this analysis, say, okay, how much do I think roughly I'll be able to get from here? Then how much is it going to cost me to have? And some of the things to think about too is, are there other people doing this in the area?
Yeah.
Do I have any way of getting this data? So let's say you're in a town like where we're here in Findlay, Ohio, and you can look around and say, okay, what is the number of people renting out and what's kind of their occupancy rates? How often are they unrented? And if, let's say, half of the places aren't rented at any given time, that could give you a kind of an analysis. Say, okay, I need to factor in like 6 out of every 12 months, I don't have a renter.
Yeah.
And you can kind of work through that. It's always important to break those costs down, right? Because in general, when it comes to renting, you're going to have a lot of wear and tear on that property. And so it's not that you can quickly turn around and sell it. Whereas the flipping, the goal is to make it look great and ready to go so somebody can scoop it up. Yeah. So if you lose your renter, it's not like you can just turn around and throw it on the market. You're going to have to probably do some repairs and get it ready to be sold. So keep that in mind. And coming to that, property management, the more you do yourself, the more likely you're going to make money off of these type of properties. Oh, yeah. Because fixing things, if I don't own this, I'm not going to take the time to fix it. I'm going to ask whoever owns this to take care of this, right? If I'm the renter and something breaks, I'm just calling my landlord, hey, such and such is not working. Come on down here, get this fixed. That's your job, right?
Oh, yeah.
And so can I do that? Am I handy? Or do I have to have somebody on call that I'm going to pay to take care of all those problems?
That's why when you're budgeting for all of this, you need to have a slush fund. Suppose that furnace breaks. Mm-hmm. Ooh, you know how expensive furnaces can be? That can be like $5,000 out of pocket in a night. So when you're looking at, say you're bringing in $2,000 a month in rent for this house or whatever, and your mortgage that you're trying to pay it off is $1,200, well, you think you're at positive $800 cash flow a month, right? But you've got to factor in all the other costs and then putting money aside. So that's why it is way harder to make a lot of money on the real estate business in the rental side than you think.
Yep. And then again, coming back to the kind of regulatory, understand the rules. Am I even allowed to rent this? If I buy a home in the middle of a subdivision, they actually may have a rule, an HOA rule or something that says no rentals. You cannot sublent this out. And then also think through, what are the rules in my state about tenant laws? There's been issues about squatting and people staying so long that they have the right to stay, and it's a lot of headache to get them out. Understand kind of where it comes to eviction procedures, lease agreements. Make sure you have an attorney help you draft that, so you're covered, but you're also doing what's best for the whole party, that there's nothing left open or any kind of hazards legally. Also think through tenant screening. How am I going to find a good person to rent this? If it's a long-term rental, you want to make sure you get somebody in there that will respect the property and take care of it and manage it. If it's a weekly rental, you're going to have rules in there that says, okay, what type of groups do I want using this? Is this a big party house that they're going to trash it, or is it more of a family rental? Those type of things. And then the last one is insurance. You say, well, I'm not living there. I don't need to have you. You're going to want to cover some liability there. And so just property insurance, there's things like that. But there are rental insurance for protecting you and the loss of income. And so you can, in a sense, cover yourself for a lot of different things. But just taking the bare minimum and hoping it works out is not a good idea, because that's a big asset and a lot of money tied up into one thing.
So Josh, we've been through 3.
Yes.
I would say number 1 being my personal favorite type of real estate investing, owning my home. We're getting to my second favorite. Let's talk about indirect real estate investment.
So up to this point, everything was involving you buying physical property. Okay. Physical property, whether it was to rent, to flip, to have yourself, any of the things, it's yours. You have the deed to it. There's another way investing in real estate, and like you said, it's indirectly. And so many different ways. These are the 4 primary. I left out the more obscure, more complex ways out of this, but in general, here's kind of the 4 main ones.
I want to get into mortgage
derivatives.
Loan,
Thank you. No.
Direct loan.
No. And if someone is super interested in that, they can go down those rabbit trails. But in general, these are the 4 main ones that most people will at least have the ability to access or get involved in. The first one are what are called REITs. It's an abbreviation, Real Estate Investment Trust, REIT. All right. So a REIT is ownership in a company, and this company's job is to manage properties.
Yep.
And there are 2 different types. There's publicly traded and non-publicly traded REITs. They're both the same thing in that what the actual company is doing is the same. They're a company who owns properties, and all the investors pool their money to help them buy more properties. And then as they collect rents, they kick out and we call a dividend. Like any other stock or investment, they kick out earnings to all the shareholders. The biggest difference between these 2, a publicly traded trades like a stock.
Yep.
Throughout the day, price moves up and down based on demand and supply, and you can liquidate or sell that at any point in time. A non-publicly traded REIT is a investment that is not on the stock exchange, is not daily traded. It is, in a sense, only available during certain time periods when they're either looking to build up a fund, initiate it, or looking to liquidate out. They'll have these periods of time. The biggest difference is, again, your flexibility of your in and out. And so a lot of times non-publicly traded REITs are going to offer a higher yield to entice people because you lose that liquidity.
One thing to keep in mind is that most REITs pay out, like you said, a nice dividend, right? Yep. Why? And the answer is because of the way that they are favorably treated from a tax standpoint, from being organized as a legal real estate investment trust, is that they have to pay out, I think it's 90% of their funds from operations to the shareholders.
Yes.
So they're not retaining a lot of excess cash. So that's how they get favorable tax treatment in the way they're doing this. But what that does mean is you typically get a pretty good yield for your holding of your REIT. So a couple thoughts on this. Number one is real estate investment trusts, was the publicly traded specifically because they're traded daily.
Yes.
Those ones, very interest rate sensitive.
Yes.
So when you're looking at how bond prices and interest rates move in opposite directions, you often see a similar sort of thinking when you're looking at real estate investment trusts, where when when interest rates go up, real estate investment trust prices go down.
Yep.
Because there's two components of that. Number one, REITs often borrow tons of money to be funding how they're operating because they're giving you their money.
Yep.
So they have to borrow more to do that. Number two, it's all about valuation, right? So when you're looking at these companies that are often viewed as really good because they pay a nice yield, well, when bond yields go up, bonds are more attractive. So you'd sell the real estate.
Mm-hmm.
So very interest rate sensitive part of the market just to keep in mind. And another thing I wanted to point out is that most people already own some of this.
Mm-hmm.
They may not know it,
yeah.
But if you're holding a passive broad index fund of large cap or small or mid cap U.S. stocks, chances are you hold potentially around 3%
yep.
or so, depending on what you're holding, of real estate in that portfolio.
Because it's
already.
A sector of the S&P 500. Real estate's its own sector.
It's a very small sector.
But it's its own separate sector or category within the S&P 500.
And I think it's around like 3% or so of the index.
All right. Well, so speaking of that, so those are individual traded securities, whether they're publicly or privately traded. The other option is using a mutual fund or ETF that is specifically focused on real estate.
Yeah. And this is just a wrapper, right?
Yes.
So it's a group, depending on, it could hold all of the available given real estate investment trusts that are publicly traded, or a portion of them or whatever. But yeah, you can buy actively managed or passively managed ETFs or mutual funds for real estate where you are getting indirect exposure to real estate through holding a group of these. It's a wrapper, right? So an ETF is a lot like a mutual fund, but it's traded daily. Mutual funds traded only once per day at the end of the day, but essentially they're kind of doing the same thing.
Yep. And the reason why those matter between individual REITs and a mutual fund or ETF is an individual REIT may specialize in a certain area. So you may have a REIT that says, we only buy health buildings, so hospitals and office, doctor offices, things like that. Great. Well, that's your exposure if you own that REIT. You could buy a mutual fund, though, that says we have that, but we also have commercial buildings and we have some multifamily homes. And so depending on how diverse you want to be in real estate, a mutual fund or ETF may broaden that for you instead of you having to find a individually traded one for each of the different sectors. So again, like mutual funds and ETFs in general, it gives you one holding with a broader exposure depending on what that mutual fund or ETF is focusing on. All right, number 3, and this is one a little bit newer. It's something that's happened for a long time, but with technology, it's become, I would say, a little more popular and a little more accessible, which is crowdfunding platforms.
Yep.
And the idea there is it's just a way for a group of people to pool money together for a purpose. And so a company or real estate investing group says, hey, we're going to fundraise to do X, well, whether it's buy this new building or, hey, we have this area and we want to develop it. Let's say I saw one and it was kind of the concept of, hey, we buy old shopping malls and then convert them into usable space.
Right.
That's our group. Our company does it. We just need funds to carry that out. So a crowdfunding platform just allows people to put funds in and allow an expert or a company or somebody to do something with that.
2 thoughts on these.
Yes.
Number 1, consider how any income you get is taxed.
Yes.
Because it can look very funny depending on how it's organized. And number 2, look at fees.
Mm-hmm.
Because obviously there's no free lunch.
Yep.
And you are participating, hopefully, in the growth of, the principal value of the real estate and the income over time. But you're just passive, right?
Yes.
So the management company is going to be taking a good chunk of profit from this as they go. So fees can be pretty pricey.
Yes. And, sometimes you'll see like a local one that maybe they're trying to improve your community. And so like you have some buy-in to that as well. So that's kind of the popularity of some of these is you can see where that impact is coming from. But yes, be very aware because there's different regulations on here versus some of the other ones because real estate REITs, real estate investment trusts, and mutual funds are all regulated by the SEC. So this crowdfunding platform is a little bit different, still has some regulations to it, but a little bit different in how it's organized.
Right.
And then the final one is using partnerships. And so the idea here is there'll be a master partner, which would be the company or whoever's really doing this work, but then they'll bring on partners, which are called limited partners. And that job for them is to provide the funding for that. And so the reason why this is different than some of the other ones is it's its own entity. You have this limited partnership where you are a passive partner in this corporation. I'm going to use that word. It's not really like a C Corp, but it's a corporation. It's its own entity. And you get income from this,
right,
and you pay tax on it. You have to file a tax return because you are an actual partner in this organization. While you're not an active one, you don't get decision-making abilities. You don't get to sit at a table during a board meeting and say, here's what I think we should do.
Exactly.
You're a limited partner. But a limited partner does get to participate in the profits and distributions. So this is a little bit more direct than some of the other ones, but not as direct as you actually owning the property. So this is kind of the in-between, is you're part of a group that's doing something, but of the group, there's these people up top making the decisions and then some other people providing some funding to it.
Right. I have some thoughts.
Yes.
I think that as an American, we live in a unique situation where owning a home, even though interest rates have gone up and house prices have gone up, the American dream involves owning your own home, right?
Yes.
That's very common. Most people want to own their own home. We live in a unique place where we have the opportunity to have 15 or 30 or whatever year fixed rate mortgages.
Yep.
Around the world, that is not normal. First of all, interest rates are usually a lot higher in a lot of areas, and they're floating typically in reset XYZ periods.
Yep.
So we live in a super unique situation here in the States where that's possible. So I think that it's a great way to build wealth over time. You know what you're going to be paying over time, and you know that historically speaking, yes, there are down years and down periods, but real estate values appreciate. It's a supply and demand thing.
Yep.
We've been underbuilding for 20-some years on what people actually need for housing.
Since 2009, we haven't kept up with the growth of population with new builds.
Yep. So there's going to be demand for housing going forward. And, people think, hey, I'm going to try and time this market and wait for mortgage rates to pull back because that's going to give me a better affordable time to enter the market. Well, that's probably going to mean more people are demanding to buy houses when interest rates are lower, so prices aren't going to come down. Right. So buy a house if you want to buy a house. We would just really recommend don't overextend yourself. Don't be house poor, right?
Right.
There was an old saying, buy more house than you can afford, but because you're going to make more money in the future.
Right, because it's going to grow over time.
And I would caution against too much of that because you can run into some issues there.
Yes.
So there's different guidelines that people use on what that should be. The Ramsey side of things would say like 25% of your take-home pay. Yeah. That's not often feasible.
25 to 30 is kind of that rule of thumb.
Yeah.
And yes, but with the way prices have moved, it's hard. I always look at it from what is my monthly ongoing cost going to be for this property and how does that affect my overall budget? And you're right. That's, thinking through property tax, mortgage, insurance, and utilities. Those are kind of the big ones. And then you got improvements and things like that. But those are the big ones that are reoccurring and ongoing. And just putting that all together and saying, what does this look like? What am I trading off for that? Yeah. Some people may say, I'll take a bigger home because that's where we're going to spend most of our time.
Yeah.
And it's okay. I'm willing to trade X for that. And others say, you know what? I don't want that because X is better or more important to me. I want to spend my money on something else.
I would also say that, as we talked about throughout, the real estate investment game, when you're specifically flipping properties or renting properties, is not easy money.
No.
It's either easy, but you don't make any money because you're hiring someone else to do it for you. That can make it easy, but you have very little profit. Or it's hard, but you make more money. There's no easy money here. So don't listen to TikTok or whatever. Like, it is really hard to make money in real estate, and some people do it very well.
Yes.
And some people make millions and billions of dollars doing it, but the average person, especially if you have a 9-to-5 job and you have a family and all this stuff, isn't going to be able to do it easily to make a bunch of money at it.
Right. And between the rental and the flipping, some of it is you don't realize it until the back end. And so you got to make sure you can afford the cash flow crunch along the way. is even with renting, getting it up and running before the first renter shows up may be a stretch for you because you got to start making payments even before rent comes in. Or you may have a prolonged period of no renter. Can I continue to afford making those payments? So you just have to be careful. Yeah. We're both big fans of real estate. I know we've both talked through that, you and I together, time and time again. I think it's an awesome diversification of your assets, and it's a great use for funds. But you got to do the research and know what it is going in. And a great way to do that is talk to a financial advisor. Make sure that it fits in your overall plan. Is this the right time to be doing these type of things?
It's also not for everyone. You don't need to buy a house, and you don't need to buy investment property. Right. But even when it comes to your own home, renting's not a bad thing.
Nope.
You can rent for your entire life and do just fine, and a lot of people do.
That's right.
And you know what you're not on the hook of? Big major expenses when that's the case. Now, you're not also benefiting on building wealth through the appreciating value of the property, but there's pros and cons.
There is.
So don't feel the pressure to be like, I have to go buy a home.
It's a decision, yeah. There's very successful people, financially successful, who are very satisfied with their life that have never owned a home or property and never intend to, and that's great. It fits well within their plan. You're right. But when it comes to real estate in general, just make sure you think it through. It should not be a rash or rush decision. But other than that, I think it's a great way to diversify if it fits there.
Absolutely. Well, thank you for listening. Remember, if you had someone asking, hey, I'm curious about investing in real estate, send them this episode. You can always do that. Email us any ideas at hello@theinvesteddads.com. Yeah, maybe you're curious about talking about your financial situation. Well, you can click on the Invest With Us tab and get a hold of us, and maybe we could be a good fit to help you out. So give us a call or contact us through that. And until next episode, thanks for being here. Have a good one.
Talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.